From New York City, for our viewers worldwide, I'm Katie Greifeld, in for Matt Miller. You take a look at S&P 500 futures right now, trying to rebound from yesterday's losses, but still on track for a weekly decline. The countdown to the open starts right now. Coming up, futures edging higher as stocks flirt with their first weekly decline since April. Another equity strategist sounds the alarm while another economist pushes back their rate cut forecast. And Treasury yields in focus ahead of a big week of U.S. economic data. We begin with the big issue. Earnings season starts winding down.
The reality is that earnings are coming in better than expected because we have a strong economy. And as long as that's going to continue, stocks are going to be fine. And so when you look at Q1 results, earnings estimates going forward, the next 12 months have been raised to an all-time high. We're not sweating the Fed cutting, June, September, whenever. We're not sweating those issues. We're focused on the fact that earnings are solid, and that gives us the comfort to continue to stay fully invested.
Joining us now, we have Nadia Lovell. She is UBS Senior U.S. Equity Strategist. And Nadia, we're going to get to earnings and, of course, what comes after earnings. But actually, I want to talk about what happened yesterday. It was really interesting. You had NVIDIA finish the day 9% higher, but even still, the S&P 500 closing down 0.7%. You think about the week that was, tech is the only sector higher on the week. What does that say about breadth in this market right now?
No, we continue to think that breadth is broadening out and improving. And yesterday, of course, the last couple of days, sort of the good news is bad news did reinsert itself, just given the ongoing concerns around inflation. And it's not too surprising to see investors take a little bit of risk off the table ahead of the long weekend, particularly after the fact that we've had such a strong rally over the last several weeks. I mean, at the end of the day, we have a market that's up 6% since late April, and nearly every sector is in the green. But overall, we do think that the macro backdrop does remain supportive for equities. And so we would expect this rally to continue to broaden out. And of course, that has to do with the earnings environment, which I know you'll get into.
Well, is that the key here? You mentioned the macro backdrop, supportive for risk assets, but then you think about the fact that we're at the tail end of earnings season, and by most measures, it was pretty good. You didn't necessarily see that reflected in the one day after performance, but you think about that battle between the micro and the macro. Is it still the macro dominating things?
Well, we're now with the earnings season, as you noted, is behind us. But we came away from the earnings season incrementally more positive. I mean, you have corporate growth that is broadening out. You're seeing upward revision to the estimates. And we think that this year you could see an S&P 500 that has earnings growth of about 11%. Of course, the larger companies are continuing to dominate that in the first half of the year. But as you get into the back half of the year, into the end of the year, we think that that gap will really narrow. Now, we're sort of in somewhat of a news vacuum, given that earnings season has wrapped. And so the market could be a little bit bumpy and more sensitive to the macro data, particularly as we get core PCE next week. But I do think that this market will continue to move higher, and we expect this market to touch 5,500 this year, supported by the earnings growth.
Well, you mentioned those big companies, so let's meditate that on that for a little bit longer, because you think about the earnings season that was, and it just seems like tech was the all-star outperformer, capped off by NVIDIA. And it almost seems too easy that really you just let your winners run. You bet on tech. You continue to watch that sector outperform. Is that the playbook here?
It's not the play, but we do have a preference for tech, but we also have a preference for industrials. And even if you look at the strong performance this year, you're also seeing utilities catching a bit. So while tech still is on the leaderboard, the top of the leaderboard, you are seeing other sectors really start to participate in this. And if we get this cyclical pickup that we expect, the recoveries that we're seeing in PMIs, that should help fuel the broadening out in some of the other cyclical areas, whether that be financial or industrials. And like I said, even like utilities, which is more defensive, as interest rates start to come down, which we do expect them to moderate, even those defensive sectors could get a relief from a lower interest rate environment.
What's the narrative around utilities right now? Because you think about the narrative for big tech, it's easy, it's AI. But I've seen several people make the call that utilities are also an AI play at this point. What's actually going on with that sector?
You do have those undercurrents in utilities. So yes, the recent rally that you've seen in utilities is to the benefit of those names that are AI exposed. Yeah, on the premise that there is going to be increase in demand for electricity as data centers get built out, and utilities as sort of at the center of that. I mean, some of the bottlenecks that you're seeing in the AI build out is really coming from industrials as well as utilities, the ability to get powers down over the longer term to some of these data centers. Today is not so much of an issue, but it's looking forward a couple of years from now that we will need to add capacity to meet that surge in demand for AI.
Well, Nadia, hang tight for just a couple minutes because you mentioned the fact that it seems like good news, bad news once again. And we did get some fresh economic data out of the U.S. this morning. So let's get to Bloomberg's Mike McKee for a breakdown. You think about what we learned with durable goods. It certainly looked like good news.
It did, and we saw the markets react to it briefly. Maybe they're waiting for the Michigan survey numbers at the top of 10, or maybe just everybody's off for the holiday early or something like that, because we kind of gave back a lot of the changes. The durable goods orders, as you mentioned, do come in higher than anticipated, up 0.7%. I guess you'd call that significantly higher because the forecast was for an 0.8% decline on the month. Capital goods orders, non-defense ex-air, up 0.3 after a negative 0.1. And that previous number graph I was showing you, it shows you why people don't put a lot of faith in the durable goods numbers, because they are so heavily revised. But for right now, it is relatively good news. And that may be why economists are marking up their forecasts for the second quarter. We have the latest Bloomberg Economist survey for the year out. And for the second quarter, they see growth coming in at 2.2%. In April, they were looking at only 1.6%. A lot of that driven by business investment, 1.9% up. PCE prices come in a little bit higher, economists think, but unemployment is unchanged. Now, as we set up for the weekend, y'all can pay no attention to the markets and the economy for 3 days. Then we come back next Friday, April PCE prices, April income and spending. PCE, obviously the big one for the Fed. The Fed blackout period begins on June 1st. You'll be glad to know that for 12 days, we will not have any Fed speak. May jobs report on June 7th, and then the May CPI is the same day as the Fed meeting. So those inflation numbers, the jobs numbers will be key, but except for any late speak on Friday next, there won't be any influence on what the Fed is thinking, at least any public comment on what the Fed is thinking about those releases.
And of course, I think a lot of people have already started their weekend. It's a good point there. But we actually did get a really interesting note out of Goldman before that long weekend, basically pushing back their first Fed rate cut call to September from July, writing that earlier this week, we noted that comments from Fed officials suggested that a July cut would likely require not just better inflation numbers, but also meaningful signs of softness in the activity or labor market data. Again, using that as a reason to push back that cut call. And it certainly feels like Goldman isn't alone in reading what the Fed officials have said and then pushing back some expectations, Mike.
Yeah, that's pretty much the case. Everybody's joining in this pushback idea, and we have the same thing showing up in the Bloomberg Economist survey. People think November, December is much more likely for a first cut. Just not enough time for the data to go the Fed's way in July.
All right, well, Mike, enjoy the long weekend when you get there. But before we get there, let's go back to Nadia Lovell of UBS, still with us. And let's talk a little bit more about the Fed, because it seems like every economist across Wall Street has pushed back their expectations for a rate cut. But then you take a look at Deutsche Bank saying that the stock market, it can thrive even without a rate cut. Even if the Fed didn't cut at all this year, things would probably be okay. Is that your base case as well?
That is our base case, that you don't need a rate cut to have the equity market continue to perform. I mean, if you look at the Fed's futures market, it's sort of been back and forth between 1 and 2 rate cuts. Our core thesis is for 2 rate cuts this year, starting in September. I mean, what you have heard from the Fed consistently is this is a data-dependent Fed, and one that needs more confidence and will have patience. We heard that all week. It seems like everyone was singing from the same hymn sheet and leaning more hawkish to the high for longer sort of narrative. I mean, Chairman Powell did try to remove the possibility of a hike from the in the press conference earlier this month, but clearly the minutes sends a different message. But we do think that when you get core PCE next week, you will see progress on inflation. We're looking for 0.25%, and year over year that's 2.7%. So again, it's still above the target, but not far from where the Fed wants it to be by the end of the year. So we think that by the time you get into September, progress made on inflation, labor market is softening but still solid, that the Fed will have enough data in hand to start to ease.
So maybe this stock market rally, it doesn't need a rate cut, but if the Fed were to hike rates, if they actually did have to lift rates beyond where we are right now, what would that mean for bulls?
It would create a headwind from a valuation standpoint. We have forward PE multiples that are over 21 times. We also have some areas of the markets that are particularly sensitive to the interest rate environment, not only from a sector standpoint, but also from a size standpoint, particularly small cap. So you could see some weakness in that if the sort of higher inserts itself again. But we think that that is a low probability. It's not a zero probability, but highly unlikely that we think that will happen. But if that does happen, it will cause some volatility in the market, and some areas of the markets will likely sell off.
So low probability, but not zero. Nadia, before I let you go, I do want to talk about your year-end target for the S&P 500, recently upgraded to 5,500. You take a look where we're trading in futures right now, currently around 5,300, so not too far away. What does the course of the rest of the year look like? Is that a straight line to 5,500, or what sort of volatility should we be preparing for?
That's a great question. And as we all know, it's never a straight line. And that's the ultimate question, is sort of like, what's the cadence of that? We wouldn't be surprised to see, the market sort of move sideways until there's a little bit more clarity in terms of the data around inflation and also the Fed's reaction function. But that said, ultimately, we think that the earnings is what's going to win the day. If the economy remains strong, which we think that it will. I mean, we're looking for, slightly over 2% GDP growth this year. And the consumer still remains in good shape, despite the fact that you're seeing some weakness on the lower end, but nothing too alarming. So we think that that should be supportive to corporate earnings. And we think that the markets will move higher, not without some volatility along the way. And we think that the next earnings season should be a good one, and that will help push the market up to 5,500.
Nadia, happy Friday. Really appreciate your time on this Friday morning. That is Nadia Lovell. She is Senior U.S. Equity Strategist at UBS. And joining us now for a look at the stocks moving ahead of the opening bell, here's Simone Foxman.
Hey, Katie. Yeah, Workday shares now down in the double digits. This after the company cutting guidance on subscription sales. This is on pace for its worst drop since March 2020. The CFO blaming this on sales scrutiny, especially in EMEA. Also lower headcount growth among its customers. Piper Sandler says this is clearly disappointing. But on the upside, we're looking at Ross Stores, which boosted its earnings per share forecast for the year. This mainly about cutting expenses. The CEO says they hope to do better. However, Citi says this was a better results than feared. And finally, Lucid, the EV maker, in a filing today saying it would eliminate about 400 jobs by the end of the third quarter. That amounts to about 6% of its workforce. Just another sign of the stress in the electric vehicle market. Remember that Tesla also talking about cutting jobs and some uncertainty there, Katie.
Simone, thank you. And on that note, coming up, Elon Musk says he's up for Chinese competition.
Tesla competes quite well in the market in China with no tariffs and no differential support. In general, I'm in favor of no tariffs.
More on Tesla next. This is Bloomberg.
Neither Tesla nor I asked for these tariffs. In fact, I was surprised when they were announced. Tesla competes quite well in the market in China with no tariffs and no differential support. In general, I'm in favor of no tariffs.
And that, of course, was Tesla CEO Elon Musk speaking at the Viva Tech conference in Paris. He also remained non-committal on building a low-cost Tesla EV. And of course, it's been a rough year for the EV maker. Disappointing sales numbers have caused the stock to dip almost 30% so far this year. And joining us now is Bloomberg's Craig Trudell. So Musk, he was coy on multiple fronts. Let's start with tariffs, though, in favor of no tariffs. But how much of an existential threat would cheap Chinese EVs be to Tesla if they actually did come stateside?
Yeah, I do think that it's the case that we don't necessarily have to worry about that threat. We seemingly didn't need to, even under Trump's tariff rates, and now that the Biden administration wants to take the tariffs north of 100%, companies like BYD just aren't coming to the U.S. market. And that being said, I mean, we're already seeing the effects of just how stiff a competition a company like a BYD is for Tesla, and that they've been losing substantial market share in China. And Musk, sort of put a brave face on the state of Tesla's business in China, but they have been losing quite a bit of share. And they've moved, from a approach of having a factory largely for the local market to, transitioning for that to be, their export base globally. And so, the Model 3s that are sold in Europe are largely, coming from China. So this is a case of trying to kind of, separate this idea of just how competitive the Chinese are from whatever Tesla's up to. And that was what Musk was trying to do yesterday.
So we're going to get to a potential cheaper model of Tesla, but let's talk about their existing models and what levers do they have to pull when it comes to pricing. Obviously, we've seen some massive price cuts coming on existing models, but how much juice is left there?
Yeah, they don't have a ton further to cut, and still sort of preserve the margins that you would like to see if you're an investor in the company. That was part of the draw here, was that, yes, you had the tech potential for this company, but also I think investors generally got used to this idea of, that this was a car company with industry-leading margins. And that is not a claim that Tesla can make anymore. And, I think we're absolutely in a position now where, rather than bringing a brand new car to market, people often refer to it as a Model 2. What they're going to try to do in terms of a lever, next here, is to take the work that was being done on that vehicle and apply it to the existing lineup and potentially be able to offer, a lower price version of the Model Y and maybe the Model 3. It remains to be seen just how excited the market will be about that. We definitely saw an indication that it was what they wanted to hear when Musk, sort of danced around the issue and generally referred to this being their plan on the last earnings call, and we had a big, pop in the stock. But that being said, that was after, the shares really taking it on the chin, and we haven't necessarily seen that run up continue with momentum.
Well, Craig, to that point, what do investors want here? I mean, with shares down 30% year to date, it seems like expectations and sentiment pretty low at this point. What would actually breathe some momentum into the stock finally?
I mean, I think they need to get the fundamentals going to some degree. They need to sort of staunch the bleeding. They need to grow again in short. And it's going to be really hard for them to do that with the existing lineup. And that's why I think, investors are really nervous about the plans that, Musk has been sort of laying for this company, because he wants to take them in the direction of, a robo-taxi model, which is entirely unproven, something he's been talking about for years and failed to execute. And he's not alone in that either. Google and Cruise, the General Motors self-driving unit, it's proven to be a really tough business. It sounds great on paper. It seems like it could be a real sort of, money spinner, putting cars out on the road that don't have any humans in them. But there's an awful lot of technology development that needs to be done. And, at a moment's notice, you can fall out of favor with a regulator and have to pull your cars off the road. Look no further than what's happened at Cruise lately.
Yeah, real boulevard of broken dreams there. Our thanks, of course, to Bloomberg's Craig Trudell. Now let's switch gears and talk about the banking world, because a number of banks are ordering staffers to report to offices 5 days a week. Here with more is Bloomberg's Michael Moore. And Michael, let's name some names here. Citi, HSBC, Barclays, calling people back.
Yeah, and these are banks that had been more flexible than, the JP Morgan or the Goldmans of the world. And what's driving some of this is there was kind of a pause on some U.S. Regulations around monitoring employees, mostly in the investment banking and trading world. And those, COVID pauses are sunsetting now. And the regulators have put in some practices that would allow people to work from home. But a lot of banks we're seeing are deciding that compliance headache is just not worth it. So they're instead calling employees back. And we've seen a number of banks so far. Others are considering it before things start to change in July on some of these policies. So we could see others follow suit.
Well, just quickly, 30 seconds. I mean, further apart, FINRA has come out and said, this isn't our fault.
Yeah, FINRA is saying, things are changing, but we have set up policies that would allow these banks to have people work from home. It's just a matter of whether the banks find that flexibility worth the costs and, time put into making that happen.
All right, Bloomberg's Michael Moore, thank you so much for that update. Coming up, the morning calls. And later, we're going to discuss the state of the consumer with Joe Feldman of Telsey Advisory Group, of course, as earnings season wraps up. This is Bloomberg. All right, it's time now for morning calls. And first up, we have Wedbush raising its Apple price target to a street high of $275, pointing to strengthening iPhone demand and potential upside from new AI technology. Next up, Wells Fargo upgrading DuPont to overweight, expecting the shares to benefit as the economic recovery accelerates. And finally, we do have Mizuho upgrading NXP Semiconductor to buy, highlighting the chipmaker's improving fundamentals. Meanwhile, you take a look at futures right now. We are still in the green. The S&P 500 higher by about 0.3% in the pre-market. Of course, just about 4 minutes away from that opening bell. You take a look at the bond market, seeing a little bit of a sell-off. Yields marginally higher when it comes to that 10-year Treasury bond. Coming up, we're going to speak to Joe Feldman of Telsey Advisory Group at the opening bell. That conversation coming up next. This is Bloomberg. This is the countdown to the open. I'm Katie Greifeld. Moments away from the start of trading, we have green on the screen behind me. You can see the S&P 500 currently higher by about 0.4%. It's the same thing if you take a look at the NASDAQ 100. Meanwhile, your small caps, the outperformer today, very early, 0.7% higher. Let's take a look at the cross-asset action right now. You can see a little bit of a sell-off in the bond market, just about a basis point higher on that 10-year yield, hovering near 4.5%. The euro camped out at 108, and you can see crude moving slightly higher here, about 0.6% right now. Meanwhile, one stock to watch at the open, Eli Lilly. Some breaking news: the company going to invest $5.3 billion to boost production of a key ingredient in its diabetes and weight loss shots after the explosive popularity of the treatment has caused supply shortages. Simone Foxman has more.
Yeah, Katie, this is an ingredient called terzepatide. It's the main active ingredient in the likes of Zepbound as well as Mounjaro. And this is to expand a production site in Lebanon, Indiana. Eli Lilly CEO David Ricks talking about their plans with Indiana Governor Eric Holcomb this morning. This would be the largest manufacturing investment in the company's history. It would entail a boosted 200 high-skilled jobs for the facility, things like engineers and scientists. scientists, as well as 5,000 construction jobs to actually expand the facility. Interestingly, though, the FDA has said that Zepbound, the weight loss version of this drug, is in shortage, but that's mainly because of the complexity of manufacturing the injectable pens, not the active ingredient. However, the CFO did say back in April that the active ingredient could be in shortage as well if demand continues apace. You know, we just keep hearing from Eli Lilly as well as their competitor Novo Nordisk about the continued applications for these drugs. For example, Novo coming out with a study this morning, kidney disease folks 1/5 less likely to die if they take Ozempic. So clearly this demand only looks set to expand, and Eli Lilly trying to position themselves for that, Katie.
Yeah, it might seem like a champagne problem, having more demand than supply, but it's a problem nonetheless. Simone, thank you for that. Let's turn to software now, because Workday cutting its full-year forecast for subscription revenue. Alex Webb has more. Alex.
Yeah, it's a tough day for Workday, looking like it's on track for its biggest decline since 2020. Don't forget, this is a company that makes enterprise resource software. Like, it's how you manage your company in terms of financial planning, human resources, plenty more besides. Now, they beat, actually, on a historic basis on almost every metric, on revenue, on earnings per share, on segment revenue. It was the forecast that was the disappointment, coming in below market expectations, or the high end is in line with expectations, but it could be significantly lower than that. And the reason for this, at least some of the analysts seem to be citing, is actually artificial intelligence. Companies are still spending money on software for the enterprise, but they are concentrating a lot of that spend towards artificial intelligence. This is not the space in which Workday plays, and therefore that is why it is suffering a little bit more than investors had expected.
Ugly day, like you said, bad day for Workday. Worst day so far since March 2020. Don't like to hear that. Alex Webb, thank you so much. Let's turn now to the private markets, because we have to talk about SpaceX. It's weighing the possibility of selling existing shares at $200 billion in valuation. That is according to Bloomberg reporting. Ed Ludlow, of course, has more. And Ed, I don't know if we can call this a mover, but tell me what's going on with SpaceX.
Well, I would say that the secondary market has become unusually liquid, both for SpaceX and OpenAI in the last 12 to 18 months. So SpaceX does tenders every 6 months or so. A tender is where staff, employees, and some early investors are permitted by the company to sell their private shares to outside investors, either existing investors on the cap table of SpaceX or new investors. And the price of that tender round is agreed between basically Elon Musk and SpaceX's CFO and whoever the lead external investor is. SpaceX does not raise any money, no new shares are issued. It's simply a market and liquidity event for the existing shares. And what one source told us is that what's being discussed in this case is a range of $108 to $110 a piece, which gives you the $200 billion valuation. The main point for me is that, yes, SpaceX does a tender every 6 months or so, but its valuation continues to go up. It is no longer the world's biggest startup. ByteDance is the world's most valuable startup, but it is by far and away the most valuable US startup. And you know, there's such close attention to what it may or may not do in the future with regards to an IPO or spin-off of its Starlink unit. So that's why we track it, but we continue to see the valuation climb.
Yeah, it's just amazing. A $200 billion valuation for a private company. It should just go public so that we'd have more to talk about. Ed Ludlow, thank you so much. Let's turn now to the consumer space, because Ross Stores and Deckers both jumping on strong results, and Denitsa Seikova is here to break it down.
Yeah, we're seeing very good news from retailers, which target actually very different audiences. If we start at Ross, we actually saw as much as an 8% jump earlier today based on better than expected earnings results and also good news in terms of profit projections. What we're seeing there is that this retailer actually lowered prices for consumers, and this is paying off. We saw comparing sales coming at the higher end of the range. We saw Morgan Stanley boosting their target to 161. Following the results, obviously the brand is targeting those lower and mid-income customers. So potentially we can see that those inflation pressures can be offset when the retailers offer discounts. And in Deckers, we kind of see different trends. Huge increase today, almost 13% based on their famous brands for running shoes, Hoka, which has been gaining so much popularity, and analysts are super bullish on it. If you ask Wedbush, they would call it one of the strongest offerings there are. They reinitiated their overweight, and now their target is $1,031. Obviously, the company beat estimates, and analysts are very optimistic about the stock.
And who am I? But I love Hokas. I've been wearing them since 2015, the maximalist shoe. Just think it's great. Anyway, Decker shares up 11%. Anita Sekova, thank you for that. Let's broaden out this conversation on retail, because joining us now, I'm pleased to say, we have Joe Feldman. He is Assistant Director of Research over at the Telsey Advisory Group. And I mean, as you can see in the earnings that we were just talking about, it really feels like a tale of have and have nots when it comes to the retail names so far this season. What's the common denominator in your sense?
Yeah, the common denominator to us has been that anybody offering value, discount prices, has actually been performing a little bit better. I mean, you look at Walmart last week, really, really strong results. This week, you've seen it from TJX and Ross, as you just mentioned with Deckers, and you know, wherever there's that value and new innovative product, that combination really seems to work for the consumer. And we've seen consumers trading down to some of those discount operators, but also that core customer has been still staying within that and responding to some of the newness that they see.
Well, I think that's a really interesting dynamic, that you are starting to see more of those promotions, basically some of these retailers offering discounts to get that maybe reluctant, maybe tired consumer back in the door. But does every type of retailer have that lever? Who doesn't that work for right now?
Yeah, I think some of the guys that are smart about not pulling that discount lever or the promotional lever are the furniture guys, the furnishing guys. So like Williams-Sonoma had very good results the other day. Their profitability was through the roof. It was really strong, and they did not promote. You know, demand was a little soft, as it has been across all of the furniture and home furnishing retailers. But all of them have been very disciplined about not promoting. We saw it with our house as well, and some of the others, where they said, you know what? Just cutting the price of the sofa or the bedroom set isn't really going to drive more sales, so let's not do it. So I like that we're seeing that discipline for some of the retailers out there.
So that discipline clearly paying off for some pockets of the retail industry. I do want to talk about the fact that, you know, you think about conservative guidance. It was interesting. We had Elf Beauty yesterday. You had Ralph Lauren delivering what a lot of people on the street said was a pretty conservative guide. And when you think about past economic cycles, periods of high inflation and weakening consumer strength there, is that what we should be expecting to see more of?
Yeah, I think the retailers are smart to be conservative with their guidance. And, you know, we know that the first quarter has basically come in better than feared for a lot of the retailers, if not even just better, like period, like Walmart was, but not getting too aggressive with their outlook for the balance of the year. I mean, we're still, you know, there's this uncertain interest rate environment. You know, we've seen price inflation has been coming down, but not to the levels that we'd like to see in some of the services side of the economy. So like that's still putting a lot of pressure on the consumer. And so you have some variables there that keeps the consumer spending in check a little bit. We're still seeing very choiceful spending. And that's why I think the retailers were smart to stay somewhat conservative. Let's not get over our skis here and say we're off to the races yet, because I don't think we are. I think they're also purchasing conservatively too. Inventory is still running pretty lean for most of the retailers.
Yeah, and I mean, to that point you made about that discipline, taking it, you know, not too aggressively. I spoke to Elf Beauty CFO Mandy Fields yesterday. She said that company just taking it quarter by quarter. It feels like that's what you have to do in this environment. But we're talking a lot about the U.S. consumer. Let's go global. Let's talk about the Chinese shopper, because you think about what we heard from luxury, from some of the beauty names. It seems like a common thread there was that the Chinese shopper just still isn't there.
That's right. We're still not seeing the Chinese shopper come back in the terms of the travel to Europe, travel to the U.S. It's a little better in Europe, I believe, but the U.S. travel from Chinese visitors is still not where it should be or where it was pre-pandemic, and that is weighing on the luxury retailers and luxury brands. We're hearing that pretty consistently. As that picks up, that should help. But that whole luxury complex has been a bit soft, and it's been challenging globally, for retail. I mean, we're seeing kind of mixed trends around the globe in Europe and China, and we'd like to see more strength. I think everybody would, and that would help drive the industry a little bit.
What do you make of some of that softness in luxury? Because, of course, we can talk about the Chinese shopper, the Chinese traveler not being there like they have been in the past. But, I mean, the common narrative is that luxury is resilient to most economic cycles. Yeah. Is that still the case, or is something changing there?
Yeah, no, we view luxury as still very resilient. I think, what we've been noticing is it's that aspirational shopper that has fallen off a little bit on the luxury side, especially in the US and in Europe, where, maybe they would, that person that would buy that entry level Louis Vuitton handbag or something, or a wallet, that's fallen off a bit. The true luxury shopper really hasn't changed that much. They have been a little more choiceful in how they spend. You're still seeing travel spending. You're still seeing them spend on high-end experiences. But, I think that it's that middle or upper income consumer where we've seen some of the pressure. And then you add on, as you just said, the Chinese consumers not traveling as much and not spending as much on luxury. And that's been really the pressure point. But we think it'll bounce back in time. It's just we're not there yet.
Not there yet. I mean, you went where I was wondering, and that is the aspirational shopper still out there? In your view, they are. They're maybe just sidelined right now. But talk to me about the full spectrum right now. Let's bring it all together. We talked about some of the discounts that are happening. We talked about luxury. What about the middle? Does the middle just fall out here, and how long does that last?
Yeah, the middle is definitely where you're seeing a lot of pressure. You're seeing people being very focused on what they spend. They're trying to stretch their dollars. That's where you're seeing Walmart benefiting, where they're seeing more customers trade in. The dollar stores are seeing that. The off-pricers are seeing that as well, where customers are trading down. They're still shopping, but they are looking for value. They're looking for discounts. They're buying more private brands from the retailers directly. Smaller pack sizes for a lot of these people. So we're seeing the spend, but just not at quite a robust level. And people are being very choiceful in how they spend. So broadly, the consumer's pretty resilient. It's just we're not seeing that excess spending at the moment. I think people are still watching their pocketbooks just to make sure, where the economy is and how their personal finances are going to look as the year progresses.
All right, I think that's a good place to leave it. Joe, really appreciate your time on this Friday. That is Joe Feldman. He is Assistant Director of Research over at the Telsey Advisory Group. Now coming up, preparing for an Ether ETF.
I think it will be very important because if the SEC approves these, it really undermines the case that they're trying to make that Ether is a security. And so we think it will be very important for these to get forward. And we're encouraged by that news.
That conversation coming up next. This is Bloomberg.
I think the SEC is probably reading the tea leaves. They realize that it's very hard for them to continue to have this sort of hostile take towards the crypto industry. I think it will be very important because if the SEC approves these, it really undermines the case that they're trying to make that Ether is a security. And so we think it will be very important for these to get forward. And we're encouraged by that news.
Well, the crypto industry inching closer to another landmark, the SEC paving the way for the eventual launch of the first U.S. exchange-traded funds that invest directly in the Ether token. Joining us now is Eric Balchunas of Bloomberg Intelligence. And Eric, I know this isn't full approval. That point has been made to me many, many times. If it's not full approval, what is this?
I would consider it just about full approval. We'll call it 99% approval. We'll leave 1% chance for some complete black swan event, but you have to understand that the group that approved the 19B4 is under the same guidance of Gary Gensler. So he's not going to have one group approve it and another not approve it. I've also heard that the other group that's working on the S1s that are not yet approved, they're working on approving them. They're going to give comments probably very soon. There could be 2 rounds of comments. So we're thinking that the S1s get approved between 4 and 6 weeks from now. So we might be looking at a late June, early July launch of these ETFs. But we see no reason that there wouldn't be approval. So I think sometimes people like to get stuck in the technical side of it. And remember, this was a top-down 180. So it's not like one group in the SEC is going to rebel and not approve it.
Yeah, I think we are deep in the technicals here. Of course, you need 2 things. You need 19B4 approval. You need S1 approval. But leaving that aside, like you said, we're 99% of the way there. And let's talk about what the future could look like, because you think about the spot Bitcoin ETF launches, I think everyone underestimated the demand that we would see for those, just billions and billions of dollars pouring into that space. Could we see the same situation here? What's your expectation for demand for these spot Ether ETFs?
Yeah, my metaphor all along has been this is like the opening band having to follow the headliner. I think Ether is going to be 10, 15% maybe of the assets of Bitcoin ETFs. That said, that's a decent amount a decent chunk of change right there, because Bitcoin ETFs have 60 billion. If you look in Hong Kong, or you look at the futures market, or the futures ETFs in the US or Canada, no matter where you look, Ether has a small fraction of what Bitcoin has. I see no difference here. Another metaphor would be silver. A lot of people who are regular 60-40 investors, they own gold. They don't really feel a need to go buy the silver ETF too. But there are certain people who just like silver. So I think that'll be the same case. I think a lot of people satisfied with Bitcoin being their sort of crypto hot sauce investment. But there definitely will be some who are interested or intrigued in Ether. There will be ETFs that come and combine the two. Those could get some bites. Overall, though, being in an ETF is being put into prime time. So for Ether, it's all good. It's all additive. But I just don't see them being, more than 15, 20% of Bitcoin tops.
Let's talk about who's who here, because you think about the Bitcoin ETF race, 10, 11 ETFs all launched at once. It's a space that's now being dominated by the likes of BlackRock and Fidelity with their new products. Who's in the running when it comes to the spot Ether race, when it comes to the actual issuer side?
Yeah, I would look for a very similar situation. It really does remind me of the Triple Crown. BlackRock, let's call them Secretariat. They're the odds-on favorite to win the next one, right? So if you have a company with a lot of assets and distribution and everybody's going out the same day, you got to give basically the favoritism would be correlated with assets and distribution. So BlackRock, Fidelity, Invesco, VanEck, ARK. I do think, though, that in this case, there could be 1 or 2 losers. In the Bitcoin ETF, everybody did well. I mean, even the lowest one was almost 100 million so far, which is a success. This case, I think there'll be 1 or 2 duds that just can't survive and probably close, but we'll see. But I'd have to give the odds-on favorite to BlackRock again. IBIT now is about to pass Grayscale GBTC, as you know, and I would think something similar with Ether, just because of their size and their just connection to all kinds of investors, retail, advisors, and institutions. They have a lot. Their tentacles spread far.
Their tentacles spread far. Let's leave it there. Eric Balchunas of Bloomberg Intelligence. Have a great long weekend. And of course, tune in to Eric and myself on ETF IQ coming up on Wednesday. That's 12 p.m. Eastern. It's a lot of fun. But before we get there, let's get some of the sector price action this morning. We're going to do that with Bloomberg's Simone Foxman.
Yeah, Katie, as stocks try to move higher on the day, we're looking broadly at sectors that are higher across the board. Every sector higher, led by consumer discretionary. We continue to get those retail earnings out. And energy and materials up for the day, though it's been a tough week for them. When you look at what's happened this week, the story has been about NVIDIA all week that we've been talking about. And frankly, the story here for Infotech has been strong as well. This is the 5th straight week of gains for the Infotech sector. But if you look down and dive down into the details, you'll see that Microsoft and NVIDIA, those are 2 of the 3 top holdings. They've had 5 straight weeks of gains. On the losing side, however, financials and real estate, tie that to what's happened in yields, this higher for longer narrative, continued woes in the property market, and finally, energy has been bouncing back today after Brent hit a 3-month low. But energy producers and services have been hit. Exxon, Halliburton, both down about 5% this week. Katie.
Yeah, it feels like big tech, your only haven in this market. Simone, thank you. Coming up, the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg. right, it's time now for the Trading Diary. What you need to be watching next week. Markets close in the U.S. and the U.K. on Monday. And then on Tuesday, we get consumer confidence data. On Wednesday, it's the Beige Book. On Thursday, even more retail earnings. Best Buy, Kohl's, and The Gap. And then on Friday, we get PCE, personal income, and spending data. That was the countdown to the open. Have a great weekend when you get there. But tune into Bloomberg Markets coming up the hour next. This is Bloomberg.